Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.
Hello and welcome back to Modern Markets. George Bell here, investment analyst at True Potential, to bring you up to date on markets over the last 24 hours. Starting here in the UK, the FTSE 100 jumped 1.4% on Wednesday after a more challenged trading session on Tuesday. There are a number of reasons for this, and just to build on a few points Jeff mentioned yesterday, the continued improvement in leading indicators which we've seen, such as the Purchasing Managers Index or PMI in areas such as the US and China, provided a boost to sentiment on the global stage, which washed through into the FTSE 100 given the international presence of the listed companies. PMIs are leading indicators because they aim to capture the future business conditions across a range of industries and sectors, monitoring new orders, inventory or stock levels, production levels, supplier deliveries, and employment, overall providing a gauge of the prevailing direction of economic trends in the manufacturing and service sectors, which overall are showing signs of expansion. Secondly, we had improvements in the UK property market, with the nationwide Building Society House Price Survey demonstrating UK property prices rising at their fastest pace in 16 years, taking the average property value to a level 3.7% higher than 1 year earlier, setting a new all-time high, though markets and economists maintain a close eye on labour data developments there. On the back of the report, home builders led the pack in the FTSE 100, citing the recovery in forward demand following lockdown and the incentives generated by the government, such as stamp duty holiday, which will be running through to the end of March 2021. A reassuring tone after the cost and revenue pressures which home builders have faced during the pandemic. Looking more domestically, the FTSE 250 closed in positive territory, up 0.6%, with the winners of the day being the companies providing technology and healthcare services, demonstrating resilience against some of the mixed messages which were coming from government yesterday around the pathway of future policy. The positive tone was also felt within European equity markets, which too booked solid gains after a more challenged start to the month, with markets in Germany, as measured by the DAX 30, closing at a 6-month high. Other major European indices adding between 0.6 and 1.84%. Contributing factors again, the improvement in the outlook of purchasing managers on the global stage being one, the relative weakness of the euro against currencies such as sterling, against the US dollar, and emerging markets such as the Brazilian real also provided some breathing space for firms translating overseas earnings, but also potentially more importantly, the increased expectation that the European Central Bank will look to provide additional stimulus to the market by way of bond purchases when they meet next week. The ECB are already acting on their €750 billion stimulus package, so why is there an expectation of more to come? Well, we know policymakers are very much data dependent, and recent consumer data has demonstrated some soft patches. Eurozone consumer prices fell in August for the first time since May 2016. Retail trade in Germany fell back 0.9% through the month of July, suggesting a slowdown in the pace of activity after a post-lockdown surge in May. The data sparked speculation around the effectiveness of some of the generous packages which have been unleashed by Chancellor Angela Merkel, such as the cut in VAT, though this was only put into practice in July. A lot can happen in a matter of weeks, and one thing this does demonstrate is the requirement for higher frequency data to gauge developments in activity. We'll find out a bit more about the health of the broader Eurozone with the retail sales data today. The optimism of further support has so far rolled into this morning, along with further news of the long-awaited €100 billion stimulus package from French President Emmanuel Macron. The package is slightly different from the current COVID-19 stimulus package, which is working its way into the system. The titled French Relaunch package aims to address the longer-term structural issues focused around longer-term investment and job creation. Furthermore, we have seen positive news around a COVID-19 treatment after Sanofi and its British peer GSK said they expected the results of their candidate vaccine by December, which takes them closer to requesting regulatory approval sometime in the first half of 2021. The expectation of central bank policy remaining looser for longer too prevailed across the water in the US, with the S&P 500 closing up 1.54% and the Dow Jones up 1.59%. Markets in the US demonstrated resilience, shrugging off the ADP jobs report, which fell short of expectations, with private businesses hiring 428,000 workers relative to the expectations of 950,000. The majority of the job creation, as you may expect, was within the service sector, so areas such as leisure, hospitality, education, health and transportation, as the economy unearths from lockdown. Though analysts were disappointed, the data does demonstrate the continuation on a path to recovery, but it does also bring into focus the requirement for Congress to overcome the impasse on the additional fiscal package. A further indication of the health of the labour market will be offered by the payrolls data released tomorrow. In Asia, key headlines were coming from China, where we had the update on the Caixin Services PMI data, after a positive read on the manufacturing side, which we highlighted earlier in the week. The services PMI was at 54 in August, so little change from July, but still sitting above that bar of 50. It pointed to the fourth straight month of growth in the service sector, an ongoing resumption of work, normalisation of demand in the post-pandemic economic recovery. New orders also rose and employment grew for the first time in 7 months. The China Shanghai Composite Index did struggle to hold on to the initial gains, closing down around 0.6% at the end of the trading session, given the developments on the political stage, with the United States, who now require senior Chinese diplomats to get State Department approval before visiting the US and holding cultural events. We continue to keep you up to date. Thank you for watching.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.